Welcome to Your New Money. I'm Bryan. This evening, our program focuses on retirement and financial planning. It never ceases to amaze me how differently individuals perceive two growth assets. This contrast was particularly evident last week when a client of mine sold a property she had purchased 12 years ago for $3 million. It was listed at $8.5 million, and they ultimately accepted an offer of $6 million. Their remark to me was, at least we made a R3 million profit on the sale. The big question, however, is that when someone invests R3 million in a share portfolio, watches it grow to 7 million, and then liquidates at 6 million, their first reaction is, I lost $1 million. Numerically, both scenarios result in a R3 million gain. The key difference in perception stems from the nature of valuation investments in unit trusts, ETFs, and share portfolios, because they're assessed on a monthly or quarterly basis, providing regular updates on those gains and losses. In contrast, no one places a signboard outside their house to revalue it on an ongoing basis. This difference in valuation is also reflected in company balance sheets, where properties are often recorded at their original purchase price rather than current market value. Joining me this evening is Polessa Dube, Wealth Manager at Centillion Wealth Advisory, and Polessa was also financial planning, FPI Financial Plan of the Year in 2002, and Daryl Bennett, Wealth Advisor of Sassman. Good to have you both on the show. But just put some context onto this, Daryl. I mean, here we are, people getting their statements on a quarterly basis. If you've got a stockbroking portfolio, you get it on a monthly basis. And people are now watching month performances. And we've just been through the most amazing January. Even though the markets were iffy, we had a great increase in January. February, all wiped out. I mean, Trump's tariffs and all Trump was up to. And just put some context on how you, as a financial advisor who deal with clients on a regular basis, so does Polessa, we'll ask her for her comments in a moment, but how are you dealing this with clients when they see 1 month up, another month down? You know, there's a lot of emotional. You've got to become what I call a financial psychologist.
Well, I say at the moment you've got the reality show with Trump and Elon Musk, as if the two of them are coupled on the tote. I think it's important that they've got to realize not to listen to the noise. There's so much noise, Bryan, out there. It's unbelievable. Now you've got social media, you're 24/7, you've got access to the internet. You don't have to even wait till the end of the month to see the valuation of your shares. You can get it daily, you can get it hourly, you can get it whenever you want. So I think it's important for clients to get a bit of perspective and think long term and look at the long-term plan. And as long as you are reviewing your long-term plan at least once a year with your financial planner, that is the time to have a look at it and to assess if you need to rebalance the portfolio, change asset classes. But to look at it on a daily basis, you're going to drive yourself crazy.
Polessa, when you talk long-term, everyone has a different expectation of long-term. I mean, there are two stories you may have heard me, but I'll mention them again. The first is my grandmother got a call from a bank manager. As they do, they trawl the accounts, they see money hasn't moved for years, and they said, can we send a financial advisor to see her? And she said, sure, but I must tell you, my grandson's in the business, and he always tells me about short, medium, and long term. Let me tell you my time horizon. Short term's a week, medium term's 2 weeks, long term's 3 weeks. You see, I am 99 years old.
Oh my.
Okay, and then a lady brought her grandson who'd inherited some money to see me, and when I asked him what his time horizon is, he told me Monday, Tuesday short term, Wednesday, Thursday's long term, medium, and Saturday, Sunday, Friday, Saturday, Sunday's long term.
Yeah.
So how do you get clients to understand the word long term?
Yeah. Look, to latch on what you were saying there earlier, Daryl, it's important to have a conversation with our clients right at the beginning, to say, just to manage those expectations, right? I often say to my clients, you know what, look at whatever statement that I send you. If you look at it in December on holiday, I'm okay with it. Look at it once a year. Fortunately or unfortunately, we do have to send regular reporting. It is what it is. In terms of terms, when we look at equity investments, or what we usually term growth assets, or your property investments, your equity or stock investments, please don't be looking at those kind of investment alternatives if you have less than, say, 8-9 years on your side.
You're even going further to what I consider long-term, 8-9 years.
8-9 years, because if you look historically, how long does it take a stock cycle from the beginning to the top? It usually averages around 8 years or so. So I would say equity investments, listed property investments, give it about 8 years. Anything shorter than that, so I would say from 2 years up until that 8 years, is what we would term medium-term investments. And then your short-term investments is 0 to 12 months.
Yeah. Melissa, let's put that in context. The fact that you've been in the market for 8 or 9 years is relevant.
Yeah.
Because it's the next 8-9 years you need to look at, because we see the cycles. I mean, there isn't a year that doesn't go by that markets don't have a month or two where they're down.
Yeah.
I mean, we saw that every single year in the last 4 or 5 years.
Yeah.
A great 21, a terrible 22, 23, 24, good, but 25 started off January. I looked at the numbers, all up 6%, gone in the month of February.
Yeah.
So people need to understand that in your case. Do you agree 8-9 years, Daryl?
Maybe even 10 years.
Guys.
It's 8, 9, 10. Absolutely. You've got to take a long-term view. Absolutely. And also you've got to realize the problem with clients and their expectations is we had a stellar year. The S&P was up 25% last year. They create an expectation that they're expecting that again. And then if the market is volatile or it's up and down, they get frustrated. They get impatient. They're expecting the same returns year in and year out, and the markets don't work that way.
Yeah.
That's why you've got to stay invested, and you've got to ride out the volatility, and there will be a lot of volatility. I mean, we've got a madman running the show in America at the moment. It's every week there's a different story.
Isn't it 2 madmen?
Well, 3. We've got Putin, Xi, and Trump. So it's going to be wild. It's going to be, we're in for a very interesting and volatile period. So
and that's where we, as financial advisors, we're all in the same boat, need to become financial psychologists, explaining, reminding clients. Because, everyone hears about risk. Everyone says, yes, I understand risk, but no one likes to lose money.
And also you've got to go back to the beginning and ascertain, why are we here? What are we investing for? What is the purpose of the investment? Is it to leave a legacy? Is it for your retirement? What are we doing this for? And absolutely, you got to always take the client back to the beginning and just hold their hand and guide them to what you're doing.
There was a survey done on pleasure and displeasure of someone going to a casino, and I don't know if you know the figures, but if someone goes with 1,000 rand and wins 1,000 rand or loses 1,000 rand, the pleasure of winning the 1,000, losing is 5 times greater than the winning. And the casino loves that because they know people have one objective: try and win your money back. And when you try and win your money back, you're obviously going to lose more. And that's what happens with investments. And as you say, Professor, if you can get clients only to look at their statements at the end once a year, that's the right thing to do. And I love clients who come to me and never looked at their statements. They don't know what's going on. But 95% of my clients get these reports. And maybe the fact that you've got to give that much more information, maybe that's a disincentive to people to see these ups and downs.
Yeah. And to look at it from another perspective, Bryan, people often work with a certain term, right? To say, I want to retire at age X. By the time I'm 65, I want to retire. The fact of the matter is, even when you're 65, you're not going to use your entire portfolio on day one of retirement. There's still another 30, 35 years, if not 40 or more, that we need to provide for. So you still have a long time, even after your retirement. So in that context, actually, even the 9, 10, 15 years is really insignificant.
If I can just add, it's exactly, retirement is just a line in the sand. It's got to work beyond that. I'm seeing a shift in the retirement fund or in the financial planning or the wealth advisory space. It's more about well-being and wellness and working with clients to help them ascertain what gives them value in life, what are the things they can do so that they can enjoy their life and not feel that they're not enjoying themselves until they get to retirement. Because you've got the monetary and the non-monetary aspect of it as well.
I've got a program which we're doing in 2 weeks' time. I've got someone from energy, someone from food and someone from healthcare coming to talk about the terrible high increases that we're having in those three fields. I mean, medical aid's up 11%, electricity up 12%, food, it all depends on your basket of food. But what people need to do in retirement in terms of bringing down those costs, because if they're going to keep escalating at greater rates than what you're going to return, the danger is, and that's why so many people are so petrified at retirement to spend money, because they feel they may run out of money because of the two challenges, inflation and longevity. But let's just talk a little bit, Daryl, and let's talk about interest rates now. There's a lot of money sitting on the sidelines waiting to invest. And whilst interest rates are slightly higher, fear and greed comes into the picture at the moment, fear. But what are you advising clients who are sitting with cash globally, who've taken money offshore, taken advantage of the million and the 10 million and have cash sitting? Are you advising them to start investing those funds, or are you happy to sit in money market?
No, absolutely. Listen, we're not going to time the market. I think what's happening with Trump at the moment is that with these tariffs and the talk of tariffs, there's a slight nervousness of perhaps inflation could come back. And the Fed, the governor of the Fed, is keeping interest rates on a pause, or the interest rate cycle could go sideways. It doesn't necessarily have to come down like it went up. It could go sideways for a while, and we can't time it correctly. So if, once again, on your intentions, if you're looking for long-term growth, go into the market. If you need a yield, if you need income, well, then those funds should be in South Africa, in our local bonds, which is yielding 10, 11%, or in cash over here. But to play the interest rates, and if they do cut the interest rates, they might only cut 25 basis points. It's not going to make much of a difference in the yield that you're going to get in cash.
Yeah, you know, when you talk about going into the market, I mean, with the markets coming down, there are a lot of stocks that have done well, but the market's not satisfied. I mean, you can't keep showing 15 to 20% returns in a market. I mean, a company does 8 to 10%, a global company in dollars, great returns, but it doesn't satisfy the street. The street's saying, no, we're worried. So a company comes out with good results, but then says, maybe we won't show those same results in the next quarter. That share gets smashed. I mean, we're seeing some stocks come down 8, 10, 12% at no time. Paula, I mean, clients don't realize that, you know, when we talk about equities on this program, they don't always realize who are we talking to. But we're talking to everyone. Yeah. Because if you've got a pension fund, if you've got an endowment policy, exchange traded fund, unit trust, you've got an amount in the equities. You know, I go back to Steinhoff. You know, we in a segregated portfolio, when Steinhoff went to the wall, people knew they had Steinhoff in segregated portfolios. In other words, portfolios that they could see. But in the unit trust space, they weren't as paranoid, and so because they didn't realize that even in the unit trusts. But I'm going to ask you to comment on that. We're going to take a short break. We've got advertisers. We've got to collect some money, and stay tuned. We'll be back shortly.